as we know, it's pretty well publicized with the Jackson Hole meeting last week, actually, where Chairman Powell, basically the head of the Federal Reserve, he basically said, we're going to start lowering interest rates. We're ready to lower interest rates. Everything is doing fine. Economy is still growing, but we don't want it to slow down too much. All that blah, 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 blah. Like, that they're doing it because unemployment is actually skyrocketing. And economy is slowing. Fed never cuts rates when the economy is doing well. That's a fact. But then this is an amazing chart that we can take a look at. So a lot of people think when the Fed cuts rates, things get better, specifically for stocks, because I'm a trader and maybe you're an investor or a trader yourself. So there is something called the Fed pivot. So Fed pivots between two, cues. Okay. One is called quantitative easing. It's called QE, which what we did for 15 years, and then inflation soared, right? And then we do something called QT. QT is quantitative tightening. So how do we loosen and how do we tighten? And that's called the pivot. So when you're pivoting from QE to QT, well, the way we do it is we lower rates, QE, we buy bonds, we flush the system with money, we print money, we increase the money supply, we do everything we can not so the economy lives. Well, that's what exactly we did, $8 trillion worth during the pandemic, okay? Because the economy came to a crashing halt, right? Okay, so that was QE, but QE has been going on for how long? Well, QE started actually with TARP in 2008 during the great financial crisis, okay? And QE lasted from 2008 all the way to 2022. That's 14 years of money pumping, money printing, increasing the money supply. Well, that's what happens, and then inflation got created. So inflation is a good thing, but certainly it's like the oil of this, engine. You need a little bit of it. You don't need you need 5 quarts of it. You don't need 50 quarts of it. Well, what happens if you put 50 quarts of oil in an engine? It'll blow up, just like it'll blow up if there was not enough oil in the engine. Okay. So, but of course, we always overshoot, like Milton Friedman said in the last segment. So now we're pivoting. The Fed is pivoting from QT, which they said they've been tightening, which they have, because they raised interest rates from 0 to 5%, right? That's tightening. That means sucking money out of the system. They also attempted to lower the Federal Reserve's balance sheet. It was at 9.5 trillion. They slowly weaned it off to 7.5 trillion. But when they do QE again, that's actually going to skyrocket back there. By the way, the Federal Reserve is not supposed to hold the balance sheet. It's not supposed to have assets on its balance sheet other than short-term transactional situations like overnight repos and bonds and notes. That's what they're there for. They're not there to hold assets, but then they are, because they rewrite the laws. When the 2008 financial crisis came, they rewrote the laws. Okay, fine. So here's the chart going back to 1960s, okay? Every time Federal Reserve raises rates, and there are all these arrows up top. Please pay attention to this. If you like, take a screenshot to study it, when you have more time. Because this is very important that you people understand this, which is because everybody's expectation is that if the Fed cuts rates, the stock market will do well. Initially, for a few months, it does. But this is an election year. The stock market's hanging in there because of the election year cycles. But look at these arrows, okay? So in the 60s, when the Fed cut the rates, meaning Fed pivoted from QT to QE, so the lower line in the chart is federal funds rate. Federal funds rate it is what rules interest rates in the country. Okay, federal funds rate right now I think is 4.5 or 4.75, or it may be 5. But in September they're going to cut it either quarter or a half, and they're going to do it again in December. They're going to do it again next year, up to 8 times by the end of 2025. So by the end of 2025, this Fed funds rate should be probably back to 2.5% from 5 or 4.5. So, but look at the correlation, and the one up top, the graph up top with the arrows, right, is the S&P 500 monthly index, the monthly performance, okay? And on each arrow, I put Fed pivot. Fed pivot meaning we're going from either QT to QE, or from QE to QT. Well, right now we're in QT, right? The quantitative tightening, we tightened, meaning we raised interest rates. And then there's lowering part of it, which is QE. Okay. So look at the first arrow. The Fed pivot happened in the 60s. They started cutting the Fed funds rate from about 8% down to about 3%. And the S&P 500 took a beating of 36% during that period. Now, you guys must understand this. All these times that the Fed has lowered rates, going back to the 60s, that's how many recessions we had. Okay? So if cutting rates coincides with a slowing economy or a recession, S&P 500 will eat it. No ifs and buts about it. But look at overall picture, right? The second time in the 70s, and I remember that clearly, when inflation soared, right? And what did they do? The Fed pivoted again to lower interest rates. And look at the market, S&P 500 index took 48% beating. These are massive numbers, by the way, because when an index goes down 48%, literally your stock is going to go down probably 80-85%, individual stocks. And then there was another pivot, smaller one, late 70s, which I remember. I was very young, but I was always into economics. I remember when gold hit 800 the first time, and Paul Volcker was the Federal Reserve chairman, he raised the rates to 20%. Look at that, right? That's 20%, people. Okay? So when the Fed raised the interest rates to kill inflation, right, what happened? The stock market took a 27% beating, but that's when things completely started to derail, right? And for years, I don't know, 3 decades, we had lower interest rates than average, but we have seen 20%. And look what the S&P 500 did from the late 70s, early 80s, all the way to the 2000s, right? And then everything was fine. Obviously, we went away from the gold standard. We were borrowing money, but our ROI on the borrowed money was 10 to 1. Economy was booming. Everything was fine. Reagan years, whatever you want to call it. Again, not politics. And then let's look at the next Fed pivot, right? The next Fed pivot came into the late 90s. And when the Fed funds rate was lowered from about 6% to close to 1.5 to 2%, S&P 500 declined 51%. The next one, the 2008 financial crisis, the Fed raised rates to slow the economy. They went into QT mode. And then obviously the housing crisis happened. And sure enough, Fed said, oh boy, we got to cut rates. And that's when we went to the ZIRP policy, zero interest rate policy. And here you go. What happened then? S&P 500 took a 58% beating. Okay. So now I have not put the arrow yet, because when they start cutting rates, I will put the arrow up top just about in September of this year, because we're going to the Fed pivot from QT to QE. And what is the result going to be? Look where the S&P 500 is. Is it going to eat it like last time on average 40 to 60%? I don't know. Time will tell, but that's why I have a negative bias, because when the Fed is cutting rates, economy is not doing well. And if we go in a recession, the market is extremely overvalued. So to me, time will tell. I'll be alive. No rush to trade anything, but this is called the Fed pivot. This is what you should expect. This is really, really an important subject you guys should understand.